Hello again, this is Rob Holford with the Wealth Management Team. Well, another interesting year is behind us, and it looks like 2022 is off to a volatile start. To help us sort all of this out, we are once again joined by Scott Kuby, Senior Investment Strategist with the Carson Group. Welcome, Scott.
Thanks, Rob. It's great to be here.
Before we get into 2022, give us a recap of 2021, and in particular, the fourth quarter.
Yeah, it was a pretty interesting year overall. We like to look at things in fives here at Carson, and so we look at 5 big events that we see. I think the Omicron reaction was interesting. We didn't see the big shutdowns we experienced. The one that really caught people's minds was inflation, and then how that was affected by supply chains, and then what the Federal Reserve is going to do with it. And a lot of the volatility I think we've seen so far this year has been uncertainty around what the Federal Reserve is going to do. We also had a big infrastructure bill, which finally got passed after multiple administrations, I think 2 or 3, interested in doing it, got passed with some bipartisan support, but it doesn't look like that bipartisan support is carrying on to other areas as well. And so from Washington's standpoint, it's going to be pretty political, but at least we got one of those bills passed, which should help some of the ailing overall infrastructure. As far as performance, it was a really good fourth quarter and a really good year overall. The one thing I would say about the fourth quarter is that rally was really concentrated in a small number of stocks. It really allowed the S&P 500 to soar, but other areas didn't soar quite as much. And I think that's one of the reasons we've seen some bigger pullbacks in the S&P 500 this year so far as we've seen the downturn. Bonds also had a slightly negative performance. One of the things I always like to emphasize for most investors is bonds help to diversify stocks, but sometimes stocks help to diversify bonds. So we had a slightly negative year. But when you look at the big performance numbers we had, even in the MSCI ACWI, which is a global index, and probably more reflective of how stocks should have performed, you still had a really good year even in a blended portfolio. It just happened that one portion of your portfolio turned out to be a little negative. We also saw energy bounce back, but that was a big rally after a pretty terrible year. One of the big things we want to emphasize here is it wasn't a terribly painful year to hold equities. Volatility was slightly below average. I think we had about 56 1% moves, about 20% less than the normal 70 we experienced. Only 70 of those were 2% moves, and a lot of them were higher, both the 1 and 2%. So the bottom line I would say for investors is, unlike how 2022 has started out, 2021 was a pretty easy year to bear risk, and that's something to keep in mind as we head into the new year.
Well, that being said, Scott, what are your thoughts on inflation, jobs, and wages?
Yeah, so inflation really has been ground zero for most investors. One of the things I had expected was volatility to pick up this year after a fairly low level last year. But one of the things I didn't expect was that extra leg up in inflation. It had really gone up a lot. That wasn't so surprising from some of the supply constraints we'd had. But as it leveled off, I thought we might see it start to slide down, but instead it legged up again as some of the fiscal aid, supply chain challenges, and really a general movement away from working for people has caused just inflation increase in a lot of different ways. Now, one of the things I want to really emphasize is capitalism is good at fighting inflation. And so we would expect companies are starting to work on ways of being more efficient all the time. And as long as they're able to do that, I think that will help. The other part that we're really struggling with is the job market. And if you look at this graph and really look at the blue line, which is the summary of some of the blue bar performance, is we've seen the number of jobs start to go down. A lot of that is because Omicron and Delta variants really have caused people to be less willing to go back to work. But there are also some other challenges as well. One of them is that this is the establishment survey. And what we're seeing is not only people leaving the workforce, but also just leaving establishment work. In other words, they're going to work for themselves. And this survey doesn't catch it. So what we've seen is a really low unemployment rate of 3.9%. But a lot of that improvement is because people are not working for big companies, but they're going to do their own thing. And those trends overall have started to affect it. The lack of supply overall is driving up wages as we have people unwilling to go back to their old jobs. And so companies are having to pay more because of it.
So Scott, how do you see the market right now?
Yeah, so one part is just to look at valuations. And this slide is probably a really good one to see, is that these are 2 different valuations. One looks backwards, one looks forward, but they tell really the same picture. Is that our overall level of valuation in the markets is high compared to where it's been over the last 20 or so years. Now, it's not as high as the tech bubble, which occurred right before this, but I think our overall sense is that valuations were allowed to rise because alternatives like bonds weren't yielding very much, and so people bid up stock prices somewhat. So if rates are going to start rising, we really do expect at least 3 hikes next year, and some folks are expecting as many as 7. And that's a lot of the uncertainty that's affecting the market right now. We would also expect that to cause valuations to wind back down. That's one of the reasons we've seen a bit of decline so far this year. Our overall expectation is that we could see earnings up around 10% and then growth in the stock market probably in the low single digits. That's our overall expectation where we think the fundamentals are going to line up.
Well, we can't let you go without talking about risk. So what risk factors are you following closely?
Yeah, I'll just summarize a couple of the 5 that we're looking at. Virus variance remains our number one, just that there would be something that's very contagious, but also very harmful health-wise. That would set the economy back globally. The virus variants have really started to flow into some of the supply chains. I think the 2, though, I want to really focus on are policy mistake that we raise rates too fast or too slow. And that puts Jerome Powell in a tough situation as far as how to manage policy. But it also makes it very difficult for investors as well. That volatility seems to have affected people more than even the very large decline that we saw, because it was very short out of the original coronavirus decline. And so because of those factors, I think we want to make sure to remind people that we actually never have hit even a 10% correction yet, that most years in the market actually do experience a 10% correction. It's a normal part of investing. And a lot of those years still have a 10% decline, and they still bounce back and end up positive for the year, or the correction occurred after we'd already rallied. And so when we get down to it, I think the big message is stay focused on the plan, reach out to you and your team if you have any questions on those. But really, I think we're getting a little bit of an extra reaction because all of a sudden this uncertainty's picked up in a few different areas and it's unsettling investors. And I'm like, duh, we've all been here before. And it's just a good thing to remember that.
Well, thanks again for your thoughts and insights on the market, Scott.
Thanks, Rob. Great seeing you again.
You too. Well, there you have it. If you have any questions or concerns, please feel free to reach out to the wealth management team or go to our website at canistillretire.com and set a call or an appointment right from there. Until next time, this is Rob Holford. Have a great 2022.